QuickBooks Pro Plus Desktop 2022 OneNote Presentation Invoice Form. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Topic Introduction tab, down in the 1340 Invoice Form tab. Also note, when using OneNote, take a look at the Immersive Reader Tool Topic Introductions, also in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. We also note that the topic introductions will have the same name and number as the presentations. Topic introductions designed to give an introduction to the topic, provide screenshots, links when applicable, and accounting background to supplement and support information in the QuickBooks presentation area. Closing the icon left-hand side, we're looking at the invoice form. We're looking at the screenshots up above, and then we'll get down to some accounting related to it. If you're going to go to the presentations and you don't have access to the QuickBooks file and you'd like to look at the screenshots to help you follow along, you can use these. We're focusing in on the customer section, this being the home page of the customer section. We're focusing in on the invoice type of form. Here's a closer look at that invoice type of form. That's going to be an increase to the accounts receivable. Other side then going to sales typically. So the invoice means increase to accounts receivable. Remember that you need to know which side of the table you're sitting on with the terminology of invoice versus a bill. When you're talking about QuickBooks, the invoice represents us doing goods and services for the customers. Ultimately, revenue, hopefully, or cash coming in at the end of the day after they pay us. The invoice form looking something like this. Invoice means that accounts receivable is going to go up. Then we have the items down below, items being a critical component to being able to create the invoice properly. We'll talk a lot more about items and how to set them up later. If they're set up properly, then it can be quite easy just to do the data input to enter the invoice without having to know the complexity of how the items are set up or the complexity of what's actually happening on the financial statements, which can be complex and a lot more complex if the invoice deals with inventory, for example. So if it doesn't have inventory that is involved, the invoice will increase, then accounts receivable, other side typically going to sales. If inventory is involved, then you'll have the increase in accounts receivable by the full amount of the invoice. The other side going to sales, but only for the amount not including sales tax. If sales tax were included, the difference between the two then going to sales tax payable, which is going to be calculated by the software as well, if and when the sales tax is populated properly. And then you're also going to have the cost of goods sold and inventory that will be impacted. The inventory going down by the cost of goods sold, tracking that in the system, having a subledger tracking the inventory as well, and then recording the cost of goods sold and expense related to the goods that we're selling. You can think about this whole kind of process kind of like a scanner. If you thought about the scanner at the grocery store, how easy the transaction is for you to get the sales price and enter it and so on. You know what the sales price is, but the scanner is also doing all that behind the scenes type of stuff to record the cost of goods sold, the inventory, and so on. And that is done only if the items have been set up properly to make the data input as easy as possible. Here's a transaction report that you can get to from the invoice. Really good anytime you enter data into the system for a form to think about the financial transaction, especially complex transactions like the invoice can be, especially if inventory and sales tax are related to it. We know that the balance sheet, the major account that will be impacted will be accounts receivable going up with the invoice. So here's the detail in accounts receivable, goes up with the invoice, goes down with the payments. That's the typical trend for accounts receivable. The materials on the profit and loss or income statement P&L is going to be the other side. This is an income account. It then going up too with the invoice because we're billing for the work that we have done. Then if we go back to the balance sheet, we know the difference between the sales amount and the amount that we're going to receive in accounts receivable that has been recorded is the sales tax that we're forced to increase or charge the customer from the government in some way, shape, or form. So it goes up as a liability due to the fact that we have to pay it in the future. And so here's the sales tax information. It goes up. These items go up when we have an invoice, and then we're going to make the payment to the state in the future. We have the customer balance summary report. This is going to be the report that's also going to supplemental report, a subledger in essence, of the accounts receivable, breaking it out by date, not by date, but instead by customer. Then we have the inventory valuation summary, another subsidiary type of report that is going to be driven by the items that we put in the invoice, which will also track the units that we have sold and the cost of those units that we have. The bottom line cost should tie out then to the trial balance or balance sheet as well. So now let's think about it in terms of journal entry, just the accounting behind it. We'll look at the debits and credits, but you can also just think about the accounts that will be impacted. If you really want to understand how to set up the QuickBooks and be more valuable as a bookkeeper or an accountant, what you want to do is every time you think of the invoices, think about what did they do to make the invoice as easy to do the data input as possible, so you can think beyond the data input, because that's where the real value is often added, or where you can often add more value. And then you also want to think about what's going to be the impact on the financial statements as you enter it. You can learn just the accounting from it by actually just going back and forth from the invoice to the financial statements and looking at the impact of it. Let's think about it in just a journal entry format. So if we had an invoice like the one up above, and we're just charging for a service item, this item back down here being a service item, no inventory, then we'd have a simple transaction. Accounts receivable would be going up because it's an invoice. The other side would be going to some kind of sales or revenue account. Fairly straightforward type of transaction. If we were to post that to like a trial balance sheet on top of the income statement, in essence, with no subcategories, beginning balance on the left, entries in the middle, ending balance on the right, the accounts receivable, if started at $2,000, would go up by that transaction by $1,600 to $3,600. The other side, on the revenue side, sales, has a credit balance account. That's not a negative sales, a credit balance account goes up in the credit direction by $1,600 to $201,600. Then the net income, which is revenue credit minus the debits of expenses, would be going up $24,710, not a loss, credit balance, up by $1,600 to $26,310. So the fairly straightforward type of transaction. If you were to drill down or look at the detail, transaction detail type of report, which is in essence a general ledger, a GL, then the accounts receivable $2,000 would be going up by the $1,600 to $3,600. The sales account, credit balance account, is at starting point $200,000, went up in the credit direction by $1,600 to the $201,600. We also would need the subsidiary ledger. QuickBooks kind of forces you to have a subsidiary ledger by forcing you to use an invoice in essence most of the time when you record to accounts receivable. QuickBooks then has the customer and can build the subsidiary ledger as well, the ledger that is broken out not simply by date, but also by customer. So we'll imagine these are the beginning balances for our 3 customers. Customer number 4 is our new customer we made the sale to. That is going up by the $1,600 to the $1,600. The 4 customers now at $600, $1,600, $400, $1,000, adding up then to the $3,600. It's a subsidiary ledger here, which in QuickBooks would be something like a subsidiary report that you would run, like an aging report or a customer detail report or a customer summary that would tie into the balance sheet line item of accounts receivable or the general ledger bottom line transaction detail reports here, $3,600. So now let's think about a little bit more complex of a transaction. Same invoice, so we have a same invoice type of transaction, but now inventory is involved. So what is this kind of transaction going to be doing? Noting the numbers are different on the invoice here than on our journal entry, but what would the general accounts be impacted if we have inventory at this point? Well, we're going to say, okay, the second transaction, we still have accounts receivable that's going to be going up, but that might be like the third thing we want to think about. We also know that the sales tax is going to be impacted, and we know that there's going to be a sales or revenue type of account. So we might first try to think about, okay, what's going to be the sales account? This would be assigned or given by the item. The item would give the sales item just like it did if it was a service item. So that might be the first building point that we would start on, even though it's the third account down here in our transaction, because it's a credit balance and we typically want the credits at the bottom. So we know it's going to go up in the credit balance. Now, again, it's a credit, so it's a credit balance account, so it goes up with a credit. Once we know what the sales price is, we could say, okay, if there's sales tax imposed on it, which in the U.S., oftentimes if you're dealing with inventory, you're more likely to be subject to sales tax, which is a state and local thing. So it'll change from state and local, but let's just assume there is a sales tax. 2,500 times, let's just assume it's 5% on the sales tax, 0.05, means you're going to have to charge another $125 in sales tax. Therefore, the amount that you're going to receive from them is going to be the 125 plus the 2,500, or the 2,625 for the total receivable we expect to get from the customer. Now, note that sales tax is kind of a tricky situation, because you might, if you were just to think about this yourself, you might say, well, why don't I set it up so that I just record the sales tax into the income line item, and then I record an expense for the sales tax that I am then expending, resulting in an increase in the sales, and then it just nets back out with an expense. We don't do that way, because in theory, the idea is that the sales tax is not charged against us. It's not a tax against us in theory, but it's a tax to the customer that's buying the stuff. And the reason I say in theory, because in real economics, you can argue like who's actually paying the tax is more of a difficult question. But the idea is the government's just making the business be their collection agency. So we are not really the ones, as the business, charging that extra $125. We're just being forced to be the collection arm of whatever government is doing that to us, right? Whatever government's making us be their collection person. So we're going to say that we got the 2,500 and increase the payable. It never then hits the income statement. That's kind of the idea. And then the receivable will be for both of those items. So that's the first half of the transaction. You could see at the second half, which is often thought of, you could think of it as, it's probably easiest to think of as a separate transaction because it has its own balance here, although it's happening at the same point in time, would be that the inventory would need to be going down, and that would need to be going down in dollar amount, and we'd also need the subledger decreasing the units of the inventory if we're tracking the inventory in the system, and the related cost of goods sold, the expense related to us using the inventory, giving away the inventory in order to generate the revenue. So the inventory would go down, cost of goods sold, then going up, expense account. So the net income account, the net income is going to be affected by the 2,500 increase minus the 2,000 expense, or the 500 on the trial balance for this transaction. Note that when you look at the invoice up top, you don't see anything related to the cost of goods sold or the inventory amounts here, because we don't want those items on the invoice, but the invoice should still record it because the system knows what those are, given the fact that the items have those included. That's why the recording of the items is really important. So if we go back down then and post this, then I'm going to say, okay, what's going to happen? The accounts receivable is going to go up. We've got these three transactions, two transactions, but these two are kind of related. Accounts receivable went up by the 1,600 and the 2,625, so that increases here. We got the other side going to sales for those two transactions, that being then the 1,600 and the 2,500. So sales then increasing by those two accounts. Then the difference here going to sales tax liability account in orange, representing the fact that we collecting money, or we're going to collect money that isn't ours. We're going to have to pay it to the government. And then the other side, inventory going down here from 4,375 down by 2,000 to 2,375. This is the dollar amount of inventory. We'll also have to look at the inventory in units with the subledger. And then the cost of goods sold going from 160 up by 2,000 to 162,000. This is an expense going up. So we saw that income went up, the expense went up. So for this transaction, the net between those two items is really the impact on the net income on down below. Between the two transactions or two invoices that we thought about, we went from 24,710 income up by 2,100 net for the income accounts, revenue minus expenses, to 26,810. The accounts receivable was at the 2,000 for the first invoice. It went up by 1,600 to 3,005. Then it went up by the second one by the 2,625, which includes the sales tax, to 6,225. This, in essence, would be similar to the transaction detail report if we double clicked on the balance sheet, go into the summary data. Then, which here's the general ledger. Sales tax payable went up by that 125 liability account. The revenue account was at the 200,000, went up by that first invoice 1,600 to 2,016, by the second 2,500 to 2,041. Cost of goods sold going up from 160,000 by 2,000 to 162,000, and finally inventory went down from 4,375 on the GL, down by the 2,000 to the 2,375. We need a subledger for the receivable account, breaking this information out not just by date as is in the GL, but also by customer, assuming this was the first customer then for this particular invoice, 1,000 plus the 2,625, which includes the sales tax that we expect to collect from them, is at the 3,625. If I add that to the three other customers, 4 total customers, we get to then the total, which should, I don't have the total up top, but it should match that 6,225. We would find that it should match that 6,225 for the total. We also need the subledger for the inventory account. So now we want to break out the inventory. I won't go into this in detail, but the idea is that the item that we put into the QuickBooks would also be tracking the units of inventory using some kind of flow assumption typically, or specific identification of the inventory units, either first in, first out flow assumption, last in, first out, or weighted average. QuickBooks Desktop defaults to generally the weighted average kind of method, but the idea is just simply being that you got to track the units of inventory as well. We're assuming here 2 kinds of inventory, unit 1, Unit 2, 2 different things that we sell. This is the first kind that we sold this time. We had 50 units on the books for cost of 50 for 2,500. We're assuming we sold 40 of them times the 50. That gives us our 2,000. That was the cost of goods sold, not the sales price. The sales price isn't on the subledger, or it may be on the actual report in QuickBooks, which is going to be the inventory summary report, because we have the sales price there too. But when you're thinking about the subledger, you're really looking at the cost. The sales price is going to be something other than the cost, because we're marking it up to get to the sales price. And so then we've got the units then that are still in ending inventory. Last time we had 50 units, we sold 40, so now we have 10 left. And then we had the 2,500 in dollars minus the 2,000 in dollars gives us the 500 left. So we're still at $50 per unit here, because we hadn't had any variation or changes in the price when we purchased the inventory. So we're left with 10 units at $50, $500 amount, and the second type of inventory that we have, 75 units, 25 cost, $1,875 amount, 1,875 plus the 500, taking us to that 2,375, which matches what's on the trial balance as well as what's on the general ledger, 2,375 there as well. Then, of course, we can see the balance sheet. Here's the balance sheet that would be generated from the trial balance. The balance sheet now having that inventory amount, 2,375, for example, accounts receivable at that 6,225, the income statement, otherwise known as the profit and loss, and then the statement of equity. If you were to enter this stuff into like an accounting system and do the behind the scenes work that QuickBooks does, you would enter the invoice, which would be creating these journal entries partially driven by the items that were set up to make the data input in the invoice as easy as possible. Those would be used to post then to the general ledger accounts. And when there's a general ledger account that needs an added subsidiary ledger, such as the accounts receivable and inventory, accounts receivable needing the accounts receivable subsidiary ledger, and QuickBooks could be called then the aging report or the customer balance detail or summary report, then the system can do that because the invoice has the customer in it, and the database system can then record that subledger inventory needing a breakout, a subledger breaking out not only by dollar amount, but also by the units of inventory. Because we have the items set up, QuickBooks can then have the information necessary to do that. The GL then would then make the trial balance. Notice I broke out the beginning and ending trial balance so we could see the impact for these few accounts, but generally the ending trial balance would be thought to be created from the general ledger, and then the trial balance would then be used to create the financial statements, which of course is the balance sheet, the income statement, and the statement of equity. Normally in QuickBooks, after we enter something like an invoice, we jump directly to the end result, QuickBooks having done all the other kind of process, and then we get to, like, say, the balance sheet, like the accounts receivable or, say, inventory, and then we say, I would like to drill down on that, possibly double-clicking on it, then going backwards from the way it was created, drilling back down on, in essence, the GL, which is the transaction detail report, in essence, something like that in QuickBooks. And that would take us then to the detail by date. And then we might say, hey, I would like to see, I was looking at inventory. I would like to see this inventory, for example, broken out by the actual items and units. So therefore, I would need some kind of subsidiary ledger in QuickBooks, that being done by running another report like the inventory balance summary, inventory balance detail reports.